Okay. My name is Efrem Schnoll. I'm a CPA. I've been practicing for 32 years. I work for a mid-sized food distribution company, but I have many high net worth clients on the side as well. And I am very well versed in the tax laws, particularly the new tax law. And that this seminar is to delve into the new tax law, but also talk about some other major tax saving areas that a lot of people could benefit from, whether it is or isn't related to the new tax law. One of the first things I like to talk about is those people who own appreciated real estate in New York City. Now, most people own real estate in a pass-through entities, not in a C corporation where you pay tax twice, first at the corporate level and then a second time when you liquidate the corporation. Most everybody owns real estate within a pass-through entity. And there's basically two kinds of pass-through entities. There are S corporations and there are LLCs. Now, LLCs have been around for about 20 years or so. Most states have created them about 23 years ago. And LLCs have substantial advantages over S corporations, although now with the new tax laws, I'll explain later, S corporations have certain other advantages. Now, in New York City, there's a very distinct disadvantage of being an S corporation, and that is S corporations are taxed once. The shareholders pay the tax on the corporate income, and that's it. The corporation itself does not pay any tax. New York City, however, because they have a taiva for revenue, to generate more revenue, and because they have huge amounts of spending. So they have an 8.85% tax rate, let's round it to 9%, on regular corporations and also S corporations. The federal government in almost every state does not tax S corporations at the corporate level, only the individual shareholders. New York City taxes both levels, both the corporate level and the individuals, which is like an extra 9% of tax to pay. Now, of course, many who hold real estate within New York City hold it within the LLC, which is a partnership type of framework. However, those who bought their real estate more than 20 years ago, unfortunately, there were no LLCs at that time, and they held it inside an S corporation, and there's an extra 9% tax to pay to New York City. And that's a lot of money, especially I have one client particularly, he bought a piece of real estate in New York City for $1 million. Now it's maybe worth $20 million or $40 million, who knows. He's not selling it, but if he would want to sell, he'd have to pay an extra 9% tax on it, in addition to the regular federal and state tax. So I've developed an exclusive strategy specifically relating to New York City appreciated real estate held within an S corporation that is able to substantially reduce the New York City corporate tax. And it's sort of like Timothy Leary, where he said, what did he say? He said, drop in and tune out. So my strategy is drop in and dilute out. A strategy where the real estate is transferred from the S corporation to a wholly owned LLC, and there's a dilution of ownership. It's sort of complicated, but basically it does work, because I've actually done it with a client 2-3 years ago, and I saved them at least $1 million. And New York City came in, audited it, and it was basically no change. So it does work. I mean, it's a gray area of the law, but this is an area that if you know anybody if you know anybody who has appreciated real estate in New York City that they want to sell, and it's within an S corporation rather than an LLC, I have a strategy that could save them a lot of money. 9% of the total is 9% tax on the profit. So that's something I don't know if any other accountants know about it, but it's something that I developed as a strategy that I developed. Now, in general, real estate, there are a lot of different ways to cut taxes on real estate. The first two I'd like to talk about are like-kind exchanges, Section 1031. Like-kind exchanges is the code section 1231 of the Internal Revenue Code. The new tax law retained like-kind exchanges for real estate only, not for anything else. Before the new tax law, you could use like-kind exchanges for equipment, for other things. Under the new tax law, it's only for real estate. And of course, a new thing that the new tax law specifically created is opportunity zones. Opportunity zones was something that Cory Booker, the Democratic senator from New Jersey, specifically pushed for. The Republicans weren't too interested, but he pushed for it, and he got it into the final bill. And so let's first talk about like-kind exchanges, and then I'll talk about opportunity zones and try to compare and contrast both. The way a like-kind exchange works is if you've bought a piece of real estate and now you want to sell it, so you could avoid paying the tax, not avoid, but only defer paying the tax, by within 45 days identifying a replacement property, and within 180 days closing on that property. Now, there's a lot of requirements. The property that you're replacing it with has to be equivalent or greater in value than the property you've sold. when you sell the property, you can't just sell it and put the money in your pocket. It has to go to what's called a qualified exchange intermediary. There are companies who specifically do this. And they hold on to the money. Within the 45 days, they make sure to identify in writing the property that you want to exchange it with. And of course, they make sure that, you generally, before you enter into such a transaction, you try to find the property in advance. And they make sure within 180 days that you do close on the other property. Now, I mentioned before that it's only a deferral because to the extent you're not paying tax, that amount you'll pay tax when you sell that property, unless you do a like-on exchange on that second property. I had a client who actually had done like-on exchange at least once or twice or three times, and now he just sold that property that he had done a like-on exchange with, and because he had done a like-on exchange, he had that much more profit that he had to pay tax on. But I had found other deductions for him, of course, segregations, other things that I'm going to go into shortly. Now, an opportunity zone is something new that the new tax law created. The way opportunity zones work is that Cory Booker, along with one or two other senators, decided that there are certain impoverished areas where, based upon the census, are lower income tracts of land. And it's not based on zip code, it's not based on city or town, it's actually block by block. You could have a block here that's an opportunity zone and a block here that's not. Oh, hi, thanks for coming. Hi, thanks for coming. So I was just talking about the 1031 exchanges versus opportunity zones.
Sure.
So sure, take a seat. So like-on exchanges are a situation where you sell a property, within 45 days of selling it, you identify another property that's going to replace it, and within 180 days you find the property that replaces it. The money from the sale has to go to a qualified exchange intermediary. You can't put the money in your pocket, and the new property that's replacing the old property has to be equal or greater than value to the old property, otherwise you're going to pay tax on at least part of the gain. Now, the opportunity zones, as I was explaining before, is an animal of the new tax law. It was specifically created by Cory Booker and certain other Democratic senators who wanted to create an incentive to invest in low-income areas. And as I was just saying, opportunity zones are block by block. It's not by zip code, it's not by city, it's not by state. It's specific blocks in a city. This block could be an opportunity zone, and the block next to it could not be an opportunity zone. The way the opportunity zone works, there are three specific tax savings relating to an opportunity zone. One, if you sell a piece of real estate or stocks, it doesn't have to be real estate. With a like-on exchange, it has to be real estate for real estate. With an opportunity zone, you can sell stocks at a profit. You sold stocks in Apple, you sold stocks in Amazon. Some stocks went up, and now the stock market's going down lately. But still, some people may still have a lot of profit on the stock market. So you sell stocks at a gain, you sell your business at a capital gain, you sell real estate at a capital gain. Then you can get a deferral on that gain up to 8 years. Also, up to 15% of that gain, even after the 8-year deferral, will not be non-taxable. So you only pay tax on 85% of the gain. And the third thing is that the money you use from that gain to buy property in the opportunity zone, a property or a business within the opportunity zone, that if you hold that property for 10 years, or that business for 10 years, that capital gain will be completely tax-free. So just to go through briefly how it works, you sell stocks at a gain. Let's say you have $2 million of stock. If you look in the two handouts that I gave, the first handout is many different topics. The handout on the bottom is specifically relating to an article by Tony Nitti, he calls himself the tax geek. A 29-page article about opportunity zones. It's very well written. You can understand even if you're not a CPA. You can understand it. But basically, he says you have within 180 days from the time you sell the stock, you sold the real estate. For example, you had Apple stock you bought for $1 million. Now it's worth $3 million. So you sell it. Now you have 180 days to take that $2 million, just the gain portion. Unlike a like-on exchange, we have to reinvest the whole thing. With opportunity zones, you invest only the part of the gain. To take that money and invest in a qualified opportunity fund, or you can invest directly. Most people are doing it through qualified opportunity funds. And there are people who are actually involved in doing that, where they take your money within the 180 days, and they take that money and invest in an opportunity zone. They buy a piece of land, and they build housing on it. They build commercial real estate on it. They buy a business. Now, one of the requirements is that you can't just buy an existing building. You have to buy a piece of land and build on it, or buy a building that needs a major degree of refurbishment, it has to be more than 50% of the expenditures have to be on new expenditures, either a brand new building that you're going to build, not something that's already built, or if it's a building that you're going to refurbish or you're going to add to, you have to spend more than 50% of the total project cost has to be a new building, a new business, a new item. So within that 180 days, you buy the investment in the Qualified Opportunity Fund. They have about 30 months to actually build a building or buy the business that they're trying to be in. It has to be within the opportunity zone. And the three advantages, of course, are, as you mentioned before, that the gain that you had on your stocks or your real estate that you sold, it's deferred for 8 years. And if you hold on for the full 8 years, up to 15% of the gain will be tax-free. The other 85% you'll have to pay tax on after the 8 years. And the other major advantages is that the piece of real estate you built or the business you bought within the opportunity zone, if you hold on to that for 10 years, then it's totally tax-free after you sell it after the 10 years. If you sell it before, it won't be taxable, it will be taxable. Now, some of the stuff expires, but the thought is that Congress, because the Democrats particularly, who are now in control of Congress, are going to want to renew this because it was their idea to push for the Qualified Opportunity Zone. Now, if you sell stock, you could do this 180-day rollover into Opportunity Zone. Let's say
opportunity zones are there?
Oh, they're all over the place. There's a website you go to and it shows you. It's all over. It's like
they have like a website you can.
There's a website that shows block by block. Yeah, block by block where it is. Right, exactly, and it's there's a lot of opportunities in opportunity zones, and there's something you can actually do which is very interesting. If, let's say, for example, you own a building not directly but through a limited partnership, an LLC or an S corp. So let's say, there's two ways in which an opportunity zone investment can be done. The partnership or S corporation itself can reinvest into the opportunity zone, or if the partnership decides or the S corp decides they don't want to do it, so you as an owner of the S corp or the LLC can take your portion of your proceeds and you could put the money in the opportunity zone, even if everybody else doesn't want to do it. So, for example. And not only that, the 180 days don't start from the time that the S corp or the LLC sold the piece of real estate. It starts from the end of the year. So, for example, let's say June 2nd, 2018, an S corp sold a piece of property at a very substantial gain. So if they want to do an opportunity zone investment, they have 180 days from June 2nd, 2018, which is only to December 2nd, 2018, which is come and gone. However, if you, as the individual owner, shareholder of the S corp or the LLC, want to take your share and invest in an opportunity zone, you have 180 days from the end of the year, 180 days from December 31st. So you have now till June 30th, 2019 to invest. Now, if of course you sold your own piece of real estate, your stocks, heavily appreciated stocks, then you only have 180 days from the time you sold those stocks. So it's a much more narrower range. Now, again, opportunity zones aren't a panacea because there's still a lot of open questions that the IRS has not yet issued regulations on. Somebody mentioned to me the other day, which he's very astute, he mentioned to me that because everybody's chasing property within the opportunity zones, that might cause an overvaluation of property within opportunity zones. So you may not get the best deal because a lot of people are going to want to buy property within opportunity zones to take advantage, and that'll push up the price.
If you scoop it up, then is someone else able to buy it from you?
The problem is that if you sell it within the first 10 years, you're not going to get a tax deferral. And not only do you not get a tax deferral, in other words, there's two things: the tax deferral on the property or the property of the stocks you sold, and a possibility of the property you bought and improved to get after 10 years to be totally tax-free. If you sell within the first 10 years, then you lose the tax deferral and you lose the total tax-free treatment of the property that you bought within the opportunity zone. So you're right, you could flip it if you want, but then you're not going to get any of the tax benefits. So that's certainly a possibility. You lose all the tax benefits as soon as you flip it. You lose all the tax benefits. So that's the downside. But
is there a way to hold on to it, but sort of sell the note on it or something?
There's probably going to be regulations on that, and I'm guessing the regulations on that are not going to be taxpayer friendly, because the IRS they're always one step behind. But as soon as very very astute accountants and tax attorneys are going to be talking about exactly what you said, the IRS is a regulation that says you can't do that. So you probably yes for now.
100-year lease.
100-year lease. Yeah, that's considered a sale. I believe regs do state specifically with purposes of like-kind exchanges that if you do a lease for 30 years or more, it's considered a sale. And if you get a 30-year lease, it's considered a purchase.
You can take out a mortgage though on it.
Yeah, with 1031 exchanges, you can take out a mortgage the day after you finish the exchange. You can't do it as part of the exchange because then you're going to get booed as part of the exchange.
Let's say you're
No,
buying,
refinance.
Yeah, right. So you buy it, and then 2 days later you refinance it. You can do that in a like-kind exchange, but it has to be a separate transaction. It should be like a week later. It shouldn't be 2 days later.
you take it like a month or two to get.
Wait like a month. Wait like better to be like that's an like-kind exchange. With an opportunity zone, if you're going to cash out by getting financing, I haven't seen any regs on it yet. You read the 29 page. It's very readable. But my guess is that it's going to be problematic because they really want people to have their money tied up in the opportunity zones to take full advantage of it. So that's something that that's something that there's a lot of. By all means, I want to move on because I don't want to spend the whole thing on opportunity zones. But I had mentioned earlier before you had come. I just wanted to just briefly review that if those people who own property within New York City that's heavily appreciated, now they want to sell. So normally there's a double tax at the corporate level if it's held within an S corporation. Now, since the mid-'90s, most people put real estate in LLCs. But people who bought real estate before the mid to late 90s put that real estate within S corporations. The problem is in New York City, S corporations are taxed at a rate of 9%. So this 9% tax is in addition to the regular state and federal tax you don't anyway have to pay. But I've developed an exclusive strategy through the means of dropping the property from the S corp into an LLC and then diluting the ownership of the LLC across to the original shareholders. I call it the like Timothy Leary, drop in and dilute out. So it's an exclusive strategy that no other accountant knows about. But I've done it with a client of mine, and I saved over $1 million. And New York City came in, audited it, and it was a no change.
Wow.
So if maybe you don't have any property held within S corporations, but if you know people who have substantial property investments in New York City and they want to sell now might be a good time to sell before the market falls any further. I have a way to avoid the New York City tax because prior to like 97, 98, the only way you would hold real estate within real estate in general was in an S corporation. In 97, 98, when LLCs became popular, everyone was putting it in LLCs. So if you know anybody, I have an exclusive strategy, and nobody else knows it. We tried it. We saved $1 million. New York City did an audit, and it was a no change. They found some stupid shareholder loan which you had to pay $2,000. But the main thing, the strategy that they didn't find anything on that. So it's something generally to consider. Now, just moving on with a lot of other areas in real estate. This is like-kind exchanges and opportunity zones is not all. There's a lot more. There's something called cost segregation studies. Now, what that is something that's been around for more than 20 years. Hospital Corporations of America versus Commissioner. What they did is they built a hospital, and they said that certain portions of the hospital, most commercial property is depreciated over 39 years, which is a very long write-off. It's a long time to get a write-off. However, they claimed that certain portions of the interior of the hospital was relating to equipment, and most equipment is written off over 5 to 7 years. So they had a very landmark case, Hospital Corporations of America versus Commissioner, where they said, where the court ruled that any portion of an interior of a building that you can claim is not part of the main structural components of the building, but rather are items that relate to the equipment inside the building or other things that are unrelated to the building, you can claim that that's 5-year property or 7-year property. Now, 5-year property and 7-year property, under the new tax law, you can write off 100% of it up front under the 100% bonus depreciation. So, for example, I just had a client last year. He's built a shopping center in New Jersey. And he spent, $20 million, let's say. He did a cost segregation study. And there are companies who specialize just in this. And about, let's say, $5 million of it was 5-year or 7-year property. So 100% of that 5 and 7-year property he wrote off up front. Now, what is he going to do with a big loss? The answer is that same year he sold another property that had a very low basis because he had done a 1031 like-kind exchange on. So he used one loss to offset the gain on the other. And we wiped out most of his tax liability. So it could, and if you can't use it, you can always carry it forward. Or if you're a real estate professional, that means if you spend more than half your time, 750 hours a year in real estate, you can qualify as a real estate professional, and you can actually deduct real estate losses. But if not, you can at least carry it forward because there's passive loss rules regarding real estate. So cost segregation studies, again, there are people who specifically do cost segregation studies. There are companies who do it. There are companies who specifically do like-kind exchanges. And now there are companies who are now specifically setting up a like-kind exchange, Section 1031, where you sell a piece of property, and within 45 days you identify another piece of property, and within 180 days you close on that property, and as long as you're paying more money for the new property than the old property, you get a deferral for the full amount of the property. The new tax law still allows you to do that, but only for real estate. So that's it's different than an opportunity zone. It's not the same level of deferrals and tax savings, but it has its own benefits. So a lot of people are doing like-kind exchanges. So as I mentioned before, the 100% bonus depreciation is something that the new tax law specifically allowed ever since September 27th, 2017, so it's been more than a year already, that you can write off those assets that have a life of 20 years or less. So, real estate, if it's a residential, it's a 27.5-year life. If it's commercial, it's a 39-year life, so you don't get the 100% write-off. But if you do a cost segregation study where you can allocate a portion, and it makes no difference whether you're building it, whether you're buying it, whether you're exchanging it, no matter what you do, you can do a cost segregation study, and you can allocate a very substantial portion of the building to the 7-year, 5-year assets and get 100% write-off on it up front. So if you're interested in real estate and you're buying or you're building, the cost segregation study is definitely worthwhile. The companies that do it they're very sophisticated. They know what they're doing. They know how they do it. They put together a report that's like 100 pages long. So if the IRS ever questions it, you have backup. This is not something the IRS typically looks at, like depreciable assets. It's not an area they typically look at. Pass-through entities. There's a lot of things the IRS doesn't really look at too much. Another area which affects real estate and affects all pass-through businesses, S corporations, LLCs, Schedule C. If you're self-employed, you have a Schedule C. Also, even Schedule E, page 1, where you report rental real estate. All those things are qualified for the new 20% pass-through deduction, which is something what I've seen some people call as the biggest new tax benefit of the 21st century. Basically what it is all pass-through entities, basically all entities except C corporations, which are corporations which pay tax at the corporate level. Almost all small businesses are set up as S corporations, LLCs. You get a 20% of your income can be excluded. Now, it sounds great, but there's a whole bunch of limitations. There's a whole bunch of you have to pass through a lot of hoops in order to get that deduction. Now, real estate also would get it too. Of course, if you have big losses because you've done a cost segregation study, or if you don't have any income to pay because you've done a opportunity zone or like on exchange, then it may not be that much of a benefit. But for those who have substantial amount of income from real estate, then the 20% pass-through deduction or any other type of pass-through entity is a very substantial tax savings. Now,
so you avoid double taxation, or
no? You see, pass-through entities, there is no double taxation to start with. A pass-through entity, there's no double taxation.
Just explain that.
A pass-through entity means a Schedule C, self-employed business income. It could also mean an S corporation, where there's no double taxation, right? Because it's only taxed once to the shareholder level. An LLC, which is taxed as a partnership, where it's also only taxed at the partner level. Mm-hmm. Or even if you have a real estate investment, which you report on Schedule E, page 1. All these things are pass-through entities because they're taxed only once, only at the shareholder level. A C corporation, which there's very few of those today because people don't want to pay a double tax, they don't want to be taxed twice. Doesn't get the 20% pass-through deduction. But there's very few people today who actually have C corporations for that reason. Now, some S corporations are actually considering moving back.
So what is 20%? What does that mean?
For example, let's say you have an S corporation. You sell widgets, for example, and you made $1 million of income, right? So basically, $200,000 of your income is tax-free. That's basically how it works. So you have an LLC where you made $1 million. Let's say you got an LLC, real estate LLC. 20% of your income is tax-free. So that's what it's. That's just looking at it at the top. There are it's a whole bunch of requirements and exclusions regarding this. For example, if you're considered a personal service type of business, what the IRS calls an SSTB, a specified service trader business. You're an accountant, you're a lawyer, you're a consultant, you're a stockbroker. All these service businesses, you do not get the 20% exclusion unless your income is below a certain level. The level is $315,000 if married, half of that, $157,500 if single. If it's above that, it gets phased out. And by the time you get up to 415,000 if married, you get no deduction at all. So, unfortunately, most people you probably know are in service businesses. Doctors, lawyers, accountants, consultants. However, there's a lot of areas where people can actually get the 20% pass-through deduction. Real estate, you can get the 20% pass-through deduction. For example, if you're a real estate broker, you can get the 20% pass-through deduction. If you flip houses, you can take a position that is the 20% pass-through deduction does not apply to capital gains. But if you flip houses and you take the position that I'm not reporting it as capital gains, I'm reporting it as ordinary business income, you can get the 20% pass-through deduction. There are certain limitations, however. One of the limitations, of course, that we just mentioned is that if it's a service business, the specified service, trade, or business, then if you're over 350,000 of income, you don't get the benefit. If you're not in a service business, you can get it if you're below 315,000, but you have to. There's a requirement to either pay wages or have a certain amount of assets, of business assets. Meaning that, for example, let's say you're an S corporation or an LLC and you made $1 million last year and you sell widgets, let's say. So you think, okay, 20% of $1 million is the 200,000 deduction, but it's not so simple. Because that deduction is limited to 50% of payroll. If you have no payroll, so you won't get the deduction. If you have zero payroll, you won't get the specified. You won't get the 20% pass-through deduction. It's called QBI, Qualified Business Income Deduction. So a lot of people, for example, of S corporations, will put themselves on payroll.
Yeah, my accountant told me to go on payroll.
Right. If you're an S corporation, you put yourself on payroll. You have to do it anyway because the IRS will impute payroll if you don't. Now, if you're an LLC, you cannot pay yourself payroll. There's this ridiculous. I would if I had money, I'd go to the tax court and I'd sue. That says back in 1968, that says if you're an LLC, meaning a partnership, you can't pay the partners. The partnership can't pay the partners payroll. So there's a way around that too. You could put your wife on payroll. You could put your kids on payroll. You could even create a second tier of a partnership and in other words, you're an owner of the first tier, but you own the second tier, and the second tier you put those people on payroll. Or you could actually have people that you put on payroll. If you're not big enough to actually have employees, then if you're an S corporation, you put yourself on payroll. So you have 50% of payroll. So there's a formula. There's a secret formula: 28.57%. It's an algebraic equation. That means that 28.57% of your pre-wage income has to be paid out in wages to max out the 20% pass-through deduction. So, for example, you had 1.4 million of net income before wages in an S corporation. You paid 400,000 of wages let's say to yourself. If you're an S corporation, you could pay wages to yourself, not in an LLC. So you're left with $1 million of income. So 20% of $1 million is 200,000. 50% of the wages, right? 400,000 is also 200,000. Same number, right? It happens to be that 400,000 of 1.4 million is exactly 28.57%. It's 2/7. 2/7 is 28.57%. So that's the secret formula. You want to pay out, if you're an S corporation, you want to pay out 28.57% of the income as wages. And if you're an LLC, you can't pay it to yourself. You have to pay it. If your wife's not an owner of the LLC, you pay it to your wife, or you pay it to your kid. You pay it to whatever. You actually put people on payroll. Those that's what you have to do in order to get the deduction. Now this is real estate also. Now real estate, what happened was Donald Trump was very upset when they were ready to pass this law because he realized as a real estate owner, he's going to not get any of these pass-through. He's not going to get the 20% pass-through deduction. Donald Trump's tax return, I believe, they claim he has like 500 to maybe 1,000 K1s from S Corps and LLCs. So he was going to lose out on this entire 20% pass-through deduction. So he whispered to some people in Congress to change the law before they passed it. No one says this, but that's what happened. So he whispered to some people in Congress, we got to do something for all those real estate investors. They're going to lose out because most real estate investors have no payroll, right? If you own a building and it's a rental, you have no payroll, right? Typically.
What's not no payroll, but you get money for the tenants?
The problem is that in order to get the 20% pass-through deduction, it's the lesser of 20% of income or 50% of the payroll that you pay. So if you pay no payroll, it's nothing. You get zero deduction. That's the law. 20% of the pass-through entity's income, or 50% of the wages you pay from that entity. If you pay no wages, you get no deduction. That's the problem. So what Donald Trump convinced Congress to do, well, he says it's not him, but okay, whatever. Maybe there's some lobbyists in the real estate industry that says, instead of doing 50% of payroll, you can do 25% of payroll and 2.5% of your assets that you own. Now, real estate generally is a very, very expensive asset. So what happens is a lot of people with,
Take a drink.
yeah, take some cakes, take some, enjoy. So for example, let's say you own real estate worth $10 million, right? So 2.5% of $10 million is $250,000. So now your 20% pass-through deduction is 20% of your income, or $250,000. So real estate isn't left totally out on the cold because it's either or. It's 50% of wages, or 25% of wages, and 2.5% of your assets. And there's a lot of other little minutiae you have to know, that it can't be more than 10 years unless it's real estate. Then it could be 40 years.
So how Donald Trump going to create?
So what Donald Trump is going to do is that the basis of his property, he's going to be able to take 2.5% of the basis of his property and use that instead of payroll. So if he has a property with $100 million, or 2.5% of $100 million is $2.5 million. So we can get up to a $2.5 million deduction because of the basis the basis of his properties. Basis means what you paid for the property base. That's what it means.
What's considered a payroll? You know,
Okay, payroll has to be, you actually have to give a W-2, you actually got to give a W-2 to somebody. You actually got to give a W-2 to somebody. And if you don't actually issue W-2s within 60 days after the end of the year, it doesn't count.
But then you have like workers, you have like 5 million workers.
Okay, so he might qualify, but the typical real estate owner who's renting out real estate doesn't qualify. He doesn't have any payroll. Now, there's two things that they did, that the IRS issued regulations just for the last couple of months that are going to be a big help to people who own real estate or other businesses as well. And those are two things. One of them is called aggregation, and the other one is called PEOs. The way aggregation works is like this. Let's say, for example, you have a real estate entity, you have a real estate management company, which pays a ton of payroll that manages all the other pieces of real estate that you have. So that has payroll, but that real estate management company shows almost no income. But you have real estate that this real estate management company provides services to, right? So you're allowed to aggregate because one provides services for the other and they have centralized accounting.
The real estate owner can
Right.
W-2 the management company.
If the management company and the real estate companies are at least 50% owned by the same group of people, meaning you can't own 10% of this and have 90% owned by other people. It has to be at least 50% common ownership. It has to be one providing services directly to the other, and it also has to be that they have centralized accounting, whatever that means.
They have to be affiliated.
They have to be very closely affiliated.
So how much percentage the other building, let's see, you have to...
Yeah, basically, the same owners have to own 50% of the management company and those other buildings in order to qualify for the aggregation. But there's something else you can do besides aggregation. It's called a PEO. Now, a PEO is a professional employment organization, where basically you want to have payroll, but you don't want to do all the payroll filings. You don't want to deal with giving people pensions and medical benefits. So you hire a company called a PEO, where you pay them and they put them on payroll. And you're allowed to count the W-2 wages of the PEO.
What do they put on payroll?
What?
What do they put
They'll
on
put the superintendents of your building, the people managing your buildings, people collecting rent in your buildings. That's how you do it.
So how much you can deduct if you have like this payroll?
So all the money's paid, all the W-2 wages paid by the PEO, you can count as W-2 wages against your buildings.
But don't you get a write-off from the expense that you're sending to the PO anyway?
Okay, you do get a write-off, but the thing is that remember, that in order to get this 20% pass-through deduction, it's the lesser of 20% of the income or 50% of the wages you paid out of those entities. If you have no wages, you get no deduction. So with the PEO, you're able to count the wages that the PEO paid. And of course, the other possibility is aggregation, where if you have multiple entities, a management company and 10 real estate companies, where the management company provides services for those 10 real estate companies, you can aggregate. You have to actually elect to aggregate. Interestingly enough, the IRS, they're so far behind, they have not yet created a form for this 20% pass-through deduction. They created a worksheet, but you don't have to attach the worksheet to the return. So that leaves us accountants with a lot of latitude to be a little bit aggressive, because there's no actual form.
So Efrem, the more buildings you have, I want to understand, you can deduct, let's say you have like 100 buildings and everything. What about the first, you said you have to have like a payroll. What happens if you have just a little bit payroll for each of the buildings?
So again, what you could do also is if 2.5% of the building's value, what you paid for the building, not what is valued now, but what you paid for it, can also count instead. So in other words, you have a choice. It's very complicated. It's 20%. It's 20% of your net income, right? But it has to be the lesser of that, or 50% of the wages you paid. W-2 wages. But if you're, let's say, in real estate and you pay no wages, you can do 2.5% of the cost of the building that you bought. For example, you bought a building for $10 million, let's say 10 years ago. So 2.5% of that is $250,000. So now your 20% pass reduction will be limited to $250,000 because you had no payroll. So you can choose: I'll do 50% of payroll, or I'll do 2.5% of what I paid for the building. They did this specifically for real estate investors, and probably Donald Trump too. But that's why they did this, because the real estate investors, the real estate lobby said we get screwed. We don't get any benefit because we don't have any, because most real estate don't have payroll, right? So they specifically did this for them. That's why they did it. So this is the kind of thing. Look, I can't expect people to understand it. It's very complex, but you have to look. You have to sit down with your accountant and figure out, okay, this is how much money this is how much profit I'm going to show from this entity, from this entity, from this entity. This is how much payroll I have. This is what the cost of the property is, and you have to sit down and figure out what can I do to maximize the benefit of the 20% pass-through deduction. If you're an S corporation, you can pay yourself wages. Let's say, for example, you're an S corporation that owns a building. Then you can pay yourself wages. If you're an LLC, you can't. You can pay maybe wages to your wife, but you can't pay it. You can't. The wages you pay to yourself don't count. Of course, if you're an S corporation in New York City, you pay an 8.85% tax in New York City, which, if you're selling, I have special strategies to avoid it. But if you're not selling, then it's a little bit more complicated. So that's another problem. So now there's a lot of people, for example, who have pass-through businesses, S corporations, LLCs, Schedule Cs. And they don't qualify at all because they're in a service business. They're a specified service trader business, like doctors, lawyers, accountants, consultants. And interestingly, architects do qualify. There must have been some lobbyists from the architectural firms who got a hold of Congress, but they qualify. I don't know why. It doesn't make sense, but they do. So one of the things you could do is if you're below $315,000, you do get the benefit. Is let's say you have $500,000 of income, you can do what's called the defined benefit pension plan. In some defined benefit pension plans, you can pay yourself as much as $200,000 into a pension plan. In fact, I have a doctor client who he's doing exactly that. He wouldn't qualify, but because he has a defined benefit pension plan, he's getting below the $315,000 threshold. So he's going to be able to qualify. So it's there are a lot of ways. There are a lot of ways to do it. If you have, for example, let's say you have a business where part of the business does something that qualifies, part of it doesn't. For example, let's say you want a company that writes software. So selling of software, that is a good, not a service, and you'd qualify. But let's say you also provide computer support for email and servers and stuff like that. So that doesn't qualify. So you'd split your business into two parts, and the part that writes the software would qualify, and the part that that provides the support services would not qualify, and you could play around with the expenses to make sure the business that doesn't qualify has all the expenses. Of course, the IRS could come in and say that that's not fair, but okay, we have some latitude here to do some things that are.
From out the IRS, they not speculate. If you have like buildings and you don't have a payroll, doesn't make a sense.
No, it does make sense, because most people who have buildings, they hire management companies to manage it for them, and therefore they do not have payroll.
The people you cleaning and the people.
A lot of those people who are doing cleaning are people who are working for management companies, or people who are their own businesses, their actual business. You're paying monies to a business, you're not giving them a W-2 wages. And that's typical in the real estate industry.
But what happens if you need to fix up stuff also?
You hire contractors. You have contractors. You have private companies that do it.
So if you hire, you have to pay tax on the things you hire.
You're right. Some real estate companies do actually have W-2 wages that they pay. Yes, some do, but by and large they don't, and that's why Congress specifically allowed this special 2.5% of the cost of the property to use that in lieu of 50% of wages as the limitation for the 20% pass-through deduction. You're right, but I'm just telling you, the reality in the real estate industry is that most do not have people on payroll. They have management companies. They have. I'm just telling you the reality, and you have to face the reality. So you have to know what to do.
What is the profit? The rent? 20%?
The rent. Yeah, the rent minus depreciation, minus all the other costs, real estate tax, utilities. So 20% of that is you actually get a deduction for that.
But you have to have the 50% the payroll. You have to show you did the
Right.
payroll.
But there's an alternative. Instead of doing 50% of payroll, you could do 2.5% of your building's cost instead. So you could use that as an alternative. Unfortunately,
the greater of whichever is equal or greater.
you can use the greater of.
Yeah.
you can use the greater of. So
Like say the 2.5%, like say you have no payroll.
to use 2.5% of the building's cost.
2.5%.
Unfortunately, if you bought the building 25 years ago, that's a problem.
Yeah.
But then you could possibly do a PEO organization, professional employee organization, and pay them, and you can count their payroll. So there are ways in which to do it, and also aggregation helps. Where let's say you're paying payroll all in one entity, but let's say you're paying W-2 wages on one building but not the other. So you can aggregate the buildings together and count them all together as one. So this way, it's another way. It's very complicated. This 20% pass-through deduction is the biggest tax benefit of the 21st century. But you look how complicated it is to figure it out. You have to be a CPA to figure it out. I mean, you need to consult with your CPAs to figure it out.
So you just need one payroll for 100 buildings, let's say.
Yes, you have to. But then you have
Because
to.
you condense all these buildings.
But you have to make an aggregation election. You have to actually elect to aggregate. It's not automatic. You have to elect to aggregate. It's an election on the return. You have to know what you're doing. It's not so simple. You have to actually have to aggregate.
The bigger the payroll, the bigger your pass-through, right?
You have to aggregate all these entities. Only one has payroll. You have to aggregate them all together, and there's only certain conditions where you're allowed to do that, and you have to elect to do it on the return. So it's not so simple. You have to. You need professional tax advisors to help you do this. Otherwise, you're going to lose a very big deduction.
If you have a lot of money, a lot of businesses are making a lot of money, can you split them up and get 20% on each one?
Yes, each one is calculated separately. But unless you elect to aggregate them, it must be calculated separately, each one separately. The problem is if some have a lot of payroll and some have no payroll, a little payroll, that's the problem. So you can aggregate under certain conditions. You can aggregate the businesses, so you can count the payroll against all the combined payroll against all the combined business income. So that's the advantage of aggregating. And the requirements are more difficult than the passive loss rules. There has to be 50% common ownership. It means that the same 50% own all these entities. Same 50% of people own the same entities. You have to have common accounting and control, and you also have to have a situation where one provides services to the other, or they're all in the same line of business. So it's a lot of requirements. So it's not so simple.
What happens if you sharing buildings with all your brothers and everything? How you deduct something like that?
So if you and your brothers own the same group of buildings, so then the 50% doesn't have to be one person. It could be the same group of people. So if you and your brothers own all the same buildings, so that's the same 50% or more that owning the same buildings. If you and your 5 brothers, let's say you and your 4 brothers own 50% of this building and 50% of this building, 50% of this building, that would qualify. It's the same group of people owning 50%. That means 50% have to be commonly owned by the same group or the same one person. That's how it works. Don't ask. This is what the IRS did. Don't ask why. You can't ask kashas on the IRS. This is what they did. We're lucky to get that, because originally they were not going to allow this aggregation, but people clamored for it, and they got it. A lot of tax professionals specifically asked for this, and they're allowing it. But you have to elect for it, and you have to meet all these criteria in order to be able to get it. So.
And you have to. How do you know how many? Let's say you have to tell them how many tenants you have in the building. Is it
No, you
related?
don't have to. No,
Yeah.
no, it's none of their business how many tenants you have. Let me go on to some of the other things. One of the things the new tax law changed is the charity. Charity is limited to 50% of income, and you think it's a lot, but I have had clients where they've exceeded 50% of income and they actually lost a deduction. They've raised that now to 60% of income. Charity now can be up to as much as 60% of income. Now, another thing the new tax law changed is that it raised the standard deduction to $24,000. So that means unless you have $24,000 of deductions, you can't itemize. And being that state and local taxes are now limited to $10,000, so for a lot of people, it's going to be difficult. You won't be able to itemize at all. So one of the strategies that is being recommended for a lot of people who wouldn't be able to itemize is to bunch up charities. In other words, if I was going to give $10,000 this year and $10,000 next year, I'll give $20,000 the same year, and I'll be able to itemize and get a deduction for it rather than doing 10 this year and 10 next year. So it's called a bunching strategy, which is something that helps with charities. Another area with charities, which is something that really has a tremendous benefit, is something called a donor-advised fund. A donor-advised fund has a whole bunch of advantages. The way it works is the donor-advised funds. I'll give you the name of one of them that they advertise on the radio. It's called the Jewish Communal Fund. The way it works is like this: you put in 100,000, a million, whatever one you want into the donor-advised fund. You get a deduction immediately, and the deduction is limited to 60% of income. Now, what happens then is that you don't have to actually give the money to the charity this year. You just give the money to the donor advised fund. Then you tell them exactly which charities you want to give the money to, and they'll do exactly what you tell them. And in fact, some of them will actually be able to give money to charities like yeshivas in Israel, even though they may not be specifically 501c3 organizations. 501c3 is the designation that the IRS allows for a charity to be tax deductible. So some yeshivas in Israel don't have 501c3, but some of these donor advised funds have the ability to actually give charities to these yeshivas in Israel, even though they aren't technically 501c3. They have to meet certain other criteria. So, for example, you made a lot of income in a specific year. So let's say you made $10 million, right? You made a lot of money. So I want to get a big deduction this year. So what do? I can give up to $6 million to the donor advised fund, but I don't have to give it all to charity now. I can tell the donor advised fund over a period of 5 or 10 years or 20 years to pay out little by little, and they'll give it to the charities of my choice when I want it. It doesn't have to be done now. So I can get the charity deduction now.
When you start the 6 million, when you're gonna
you get the deduction right. You get the deduction right now, but you don't actually have to pay it out. You don't have the donor advised fund doesn't have to pay it out to the charities until a year from now, 2 years from now, 5 years from now, 10 years from now.
You give them the $6 million right away?
Right away, and you get the deduction right away.
But even the organization just pays slowly.
Slowly, right? Exactly. They're allowed to do that, and it's completely legal.
And they let you invest the money also.
And they let you invest the money, and they give you a whole slew of investment choices, and they do charge they charge you a fee like any mutual fund. I was looking at Jewish Communal Fund. It was 0.75% they charge. They charge a fee, but you can invest any way you want. They give you a whole choice of mutual funds, or I don't know if you want to go in mutual funds now with the stock market the way it is, maybe like a money market fund if you're afraid of more declines in the stock market, but they give you a whole bunch of choices. And there's another advantage too, that if, for example, you have grandchildren in yeshiva, that if your grandchildren happen to be in a certain yeshiva and the donor advised fund happens to give money to that yeshiva, you ask your tax advisor if that qualifies. I'm not going to say if it does or it doesn't, but ask your tax advisor. Ask your tax advisor. Okay, whatever. There's something in the tax law called quid pro quo. So it's dependent on that question. So this is something to discuss offline.
Yeah.
So anyway,
you pay your friend in Chicago.
No, you can't do that. No, you can't do that. Now there's another thing you could do as well. If you have stock that went up in value, now the market's going down, but let's say you bought Microsoft and it was $1, now it's worth 1,000 times what you originally paid for it, even with the market declines.
Yeah.
So let's say I bought $1 million of Microsoft and now it's worth $10 million, right? So if you give the $10 million to charity, so you get a deduction for $10 million. It's limited to 30% of income though. Appreciated stock is limited to 30%, not 60%. You don't pay tax on that $9 million of gain. And the same is true with real estate. You bought a building for $1 million, now it's worth $10 million, you donate the building to a charity, so your deduction is limited to 30% of income. So obviously if it's more than 30% income, you're not going to get the deduction. However, you get the charitable deduction for the full value of the building now, and you don't pay tax on the gain. So you permanently avoid paying tax on the gain. So if you have stocks that went up in value substantially, or a piece of real estate went up in value substantially, and you want to give a large chunk of money to a charity, so you can just give them the stock directly, and you can give them the building directly, or you could give it to a donor-advised fund, and the donor-advised fund can pay it out little by little. So that's another area that, for those who want to give a substantial amount of money to charity, so you permanently avoid paying tax on the gain on the stock because you gave the stock directly to the charity or the donor-advised fund.
You get another 30% deduction in your income.
Well, no, the deduction is you get the complete deduction. In other words, for example, if your income is $10 million, then you can't do this for more than $3 million. If it's more than $3 million, you can carry it over up to 5 years, but that's it. So
what happens if you build somebody a synagogue? Let's say for a group of people, you're going to get deduction for the value of how much you...
That's not a capital gain property. That's an ordinary income property because you built it. It has to be a property that you bought, held for investment, and sold after 12 months. It has to be at least 12. You have to have held it for at least 12 months. You can't. It doesn't work if you build it yourself because you're considered a dealer in properties. So it doesn't qualify. You'd have to buy a piece of real estate as investment, hold on a minimum of 12 months, and then donate it, or buy stocks for investment, hold on a minimum of 12 months, and then donate it directly. The stock has to be donated directly to the charity. You have to tell your broker to transfer it to the charity with a donor-advised fund. So it's like a double dip because you're getting a charity deduction and you're not paying tax on the capital gain. So it is a double dip, and it's something that if someone made a lot of money in the stock market or has a substantially appreciated piece of real estate, you can then get you can then avoid paying tax on the gain and get a charitable deduction. So, of course, you have to want to give that much money to the charity. You're giving up the money, obviously. But if you were going to give that much money anyway, or if you want to give it over a period of time, so give it to a donor-advised fund. So that's something that you could really it's a real tax saver right there. Again, if you want to enter in this kind of transaction, speak to your tax advisor. This is not something you just want to do just without thinking, without going through it, without looking to see how much you paid for the stock, what is it worth now. Find a charity that will accept it. Not all charities will accept stock. You have to find one that will accept it because they have to be able to have a brokerage account. It's something that has to be done with some forethought. You can't just, I want to just give stocks to UTA. Probably UTA would probably accept it. UTA is United Medical Academy. By the way, every time I have a client and I'm ready to finalize the return, and I see they owe some money or their refund isn't as big as I had hoped, so I always ask them, "Are you sure you didn't give another $10,000 to UTA, United Medical Academy of Satmar?" It's like, and I don't care, even if they're not Satmar, I ask this question. Even if they're not Jewish, I ask them that question because maybe they gave some more money that they thought they didn't know about. So. That's just a joke. But a lot of people don't. Unless you're Satmar, you're not going to give money to United Medical Academy of Satmar. But okay, whatever. Anyway, talking about capital gains. Some people, for example, buy mutual funds and they reinvest the dividends over and over again. They reinvest and reinvest and reinvest, and they don't realize it. And they might have bought a mutual fund 25 years ago, and they reinvested it over and over again the same dividends. And then they sell it, they think they have a very big gain. And the answer is they don't have a very big gain because they've reinvested the dividends. Now, going back a few years ago, the IRS started requiring brokerages to report the exact cost of the stock that you paid and the sales price. So but if you bought it before 2011, they don't have to report the cost because it goes way so far back. They don't have records that far back. So if you bought mutual funds, let's say prior to 2011, and you reinvested. So instead of you sold it for $25,000, and it said I bought it for $10,000. Yeah, but you reinvested the dividends over and over again. So maybe it's worth $20,000. Maybe the reinvested dividends, your real cost is $20,000. So you made a lot less money than you thought. I had a client I did this for. I saved him a ton of money. I said I spent tens of thousands of dollars. I went back 25 years and actually I had to recreate it by going on the web and figuring out what the value was of this specific fund. So I saved them a lot of money. Also, some people, for example, they buy a stock and it becomes worthless and they forgot about it. And now they have some big capital gains because they sold some real estate or they sold stocks at a big capital gain. You know what? Think back way back when you bought that stock for 10 years ago or 20 years ago. It's now worthless. You can deduct that. However, in such a case, it's best to deduct it the year before you have the big gain because then the loss is simply a carry forward and the IRS is not going to notice it. They're going to look at the return, they're going to see a loss carry forward. See, with capital losses, the limit is $3,000 a year. And it's been that way for the last 40 years, that if you lose $1 million in the market, and believe me, people back in 2008, some people lost more than that, you can only deduct $3,000 of the loss. So there's $3,000 per year of the loss. So it would take, if you lost $1 million, it will take you 333 years to deduct it. But if it's some future year you have a big capital gain, you can deduct it against that gain. So just be aware that you might have had worthless stock. You might have lent money to a cousin they never paid. It's called a non-business bad debt. You can deduct that as a capital loss as well.
You can deduct it against the gain.
Yeah. If you lent money to somebody and they didn't pay you back, even if it's a relative, if it's a bona fide loan,
You also lost money.
No.
1099 the relative?
no. What do you think? Forgiveness of indebtedness?
Yeah.
No, because you could claim that I didn't give him a 1099 because it was technically disputed, and I still had an intention to go after him and whatever.
So that they won't make you show proof of that.
Failure to file a 1099 is a $50 penalty. $50 penalty. You'll pay the $50 penalty. Okay.
Got it.
So it's technically it's an issue, But and also remember something else: if they're in such financial straits that they can't afford to pay you, they can do an insolvency exception. If you'd like, I'll go into the. If anybody here knows anybody or if anybody here has an issue where they didn't pay a lot of debts and they're worried about getting a 1099-C for forgiveness of indebtedness, I'm an expert in that area. I have a whole bunch of different ways to avoid paying tax. There's something called the insolvency exception. There's bankruptcy exception. There's the real estate exception where you can actually reduce the value of the real estate rather than paying tax. Where, for example, you had forgiveness of indebtedness.
Oh, this is very like a 1099-C.
1099-C.
What's that? I run into that a lot with people. We
What
do
if
a lot
they're
of short
not
sales. Let's say somebody owes $1 million in a house.
Well, you don't get that. The person who you sold it to gets it.
So yeah, you have to explain to them what are they.
Okay, so what they can do is, so here's what they do. There's two things. There's two or three main ways to avoid 1099-C.
Residents,
They
primary
like live
residents.
there for more than 6 months.
No, so there's several things you can do. First of all, if it's a primary residence, then up to $2 million is tax-free. However, that tax break expired at the end of 2017. However, there's hope still that the buffoons in Congress will get their act together and renew it because a lot of people are still, what happened was it expired in 2017. It expired in 2016, and then 2018 they extended it only to the end of 2017. Dummies! Why did they extend it to the end of 2018? leave it to Congress to pass such a stupid law. So the hope is that sometime in January, February, or March, Congress is going to get their act together and extend it now another year. So if they do, so they'll extend it through 12/31/18. That for the first $2 million of forgiveness of indebtedness on a primary residence, it means you have to have lived in it, is tax-free, and you have to check off a specific box on Form 982. You don't get it automatically. You're going to get the guy's going to get a 1099-C, and that 1099-C is taxable unless he actually files Form 982, checks off a box that says this is mortgage. This is a mortgage on a primary residence that I've lived in, and therefore the first $2 million is tax-free. So it's not automatic. You have to fill out the right form, and you have to hope that Congress is going to renew the law. However, there's two other exceptions: bankruptcy. If the person declared bankruptcy, you get off scot-free. You don't have to pay tax.
When bankruptcy after he's given the 1099, or within the course of the past 5 years.
I think it would have to be the year of. But there's also another exception called insolvency, where you show that your assets, your liability to exceed your assets, which I've done that for quite a few times for clients, and there's a lot of latitude to be aggressive in that area. Speak to your tax advisor when discussing these matters, because
If I buy a receivable that's worth $1 million and I pay $800,000 for it, and then it never gets delivered, the receivable never gets delivered. Do I write off $1 million or do I write off $800,000?
you can only write off what you paid. But you're in the business of buying and selling these receivables. Most likely, you would take it as an ordinary loss. Because I know your business is typically investing in these types of troubled debts. So you could probably write it off as an ordinary loss, not as a capital loss, because this is your business. So you have to be careful. I happen to know. You see, you have to ask questions sometimes, because if you're not in the business of buying and of investing in troubled debts, then typically it would be a capital loss. It would be a non-business bad debt. But if you're in this particular business, it would be an ordinary loss, which is much better than a capital loss. Capital loss is limited to $3,000 per year. So if you have people who have this issue of getting 1099-Cs, I have a whole toolkit of ways to avoid paying tax on it. The primary mortgage up to $2 million exclusion, insolvency exclusion, bankruptcy exclusion. There's a lot of different ways to avoid paying tax, and you have to look at all the different possibilities. So it's a complex area, and it's very unfair because typically the people who are getting a 1099-C for cancellation of indebtedness, forgiveness of debt, are in a very difficult financial situation. So they don't have the wherewithal to pay the tax. So it's quite unfair. But I have ways. I mean, it's all based upon all the exceptions on Form 982. It's all part of the law. So you have to know how to use it to your advantage. Some people. Switching to another topic. Some people have invested monies with fraudsters. Now everybody thinks of Bernie Madoff, but Bernie Madoff is only one of many. People have lost money with all kinds of investments. There's Ponzi schemes. There's and everything in between, Ponzi schemes and outright theft and everything in between. And I was reading an article. You're going to get a laugh out of this one. I was reading an article of a very hoity-toity tax attorney who said the article was entitled "The Sky is Falling." The sky is falling. You can no longer deduct after under the new tax law casualty losses. A casualty loss is a fire, a flood, or a theft, or an embezzlement, or a Ponzi scheme. That's right. These are all casualty losses, unless it's in a presidentially declared disaster area. So now, you think that if you have a loss from a Ponzi scheme or some other type of financial fraud, you can't get the loss, and that's what this whole article was about. That the sky is falling, you can no longer deduct losses from these types of situations. However, if you read the tax law specifically says that personal casualty losses are not deductible unless there was a presidentially declared disaster area. Personal. That means if it's an investment, which most Ponzi schemes are investments, it is deductible. Or if it's a business type of loss, let's say your business invested in this, then it is deductible. So this prominent tax attorney who wrote in an article in a prominent tax publication that the sky is falling, no, the sky is not falling. If it's a Ponzi loss and it's an investment style loss, then the loss is deductible, even under the new tax law. It's only if it's a personal casualty loss, like if someone's house burnt down, or there was a flood, or there was an earthquake, or whatever, that is not deductible unless it's a presidentially declared disaster area. So, and not only that, for those people who want to deduct Madoff-style losses, there's something called Rev Proc 2009-20, which basically says you don't have to prove anything. You don't have to. As long as there's a preponderance of evidence that this guy's a fraudster, then you show how much your investment was, how much you got back, how much you're left holding the bag for, and you can deduct 95%
They
of
don't
it.
want like a proof, like you got.
You don't have to prove it anymore. Now, if you file Rev Proc 2009-20 and it's -20 and it's attached to the return, they will not audit you. They'll just take your word for it, but you're limited to only 95% of the loss. You can't take 100%. They make you take 5%.
Why doesn't everybody do that? Even people that never went into Madoff.
It has to be a real loss, and it has to be, you can't just make it up. It has to be a real loss. But they're not. In the old days, if you had a fraud loss or a Ponzi loss, they wanted proof that the guy was indicted, that the guy was found guilty, and otherwise they wouldn't allow it. I've had ordered situations like that. The whole idea of this, after Bernie Madoff, they specifically passed this revenue procedures called a Rev Proc, particularly for the Madoff victims, but other people as well, that by filing this form and taking only 95% of the loss rather than 100%, you can just get the whole loss and they won't question it. I mean, technically they could question it, but by and large they will not question it. And it's
So if you got screwed by like a Ponzi schemer, you're better off going over to him and saying, "Give me Mazumin for 70% of whatever it is that you owe me," and then
I would not recommend that.
When it comes out that he gets.
I would not recommend that because if you actually got some of the money back, you have to subtract that from the loss. So I really wouldn't recommend that. But I'm just saying. But if it's a bona fide loss with a real Ponzi schemer, then even if the guy wasn't indicted, but if there was a preponderance of evidence and there was enough clearly to show that the guy was guilty,
And it could be from a few years ago.
Sure.
It's like some guy, let's say, screwed me out of $250,000.
Sure.
I never prosecuted him because I knew that he's got dirt on me also. So I ended up just not let's say prosecute or suing him.
As long as you could show that there's some sort of evidence that this guy's a schemer and a fraudster and the guy's written up in the paper as being a baddie, then I think that's sufficient. It's probably sufficient for doing it this way. And this loss is not subject to alternative minimum tax. It's not subject to the 2% AGI limitation. It's a full deductible loss that's subject to, you can report on Form 4684 and 4797, and you can just deduct it as an ordinary loss. And it's however, if it is subject to a SIPC claim, and a SIPC is if it's a financial court of fraud where they can go to SIPC. SIPC is with stockbrokers; they have to be a member of SIPC.
Yeah.
So then you only can deduct 75% of the loss. So a typical Ponzi scheme is only 95%, but if it's like a stock kind of fraud, like a pump and dump,
recourse there.
but there's some sort of recast against SIPC, so they'll only let you do 75%. Yeah, that's yeah. So it's So the sky didn't fall. You can still get, even under the tax law, you can still get the Ponzi losses. Just so you know, it's not. Some people get it wrong. Some people get it wrong. It's hard to believe. There are still some good tax shelters out there, like for example, working interests in oil and gas. For example, you buy. I know the price of oil and gas went down a lot lately, so maybe now is a good time to invest. If you put, let's say, $100,000 in oil and gas investment. They take that money, they pay the money for a turnkey drilling contract. So typically you'll get $100,000 deduction. And because it's considered, it's not a limited liability, but it's a company, but rather a general partnership, you can actually get that loss, and it's not considered a passive activity.
I mean, 95%.
No, 100. You can get 100%. You can get 100% of it. So if you're interested, if you have a lot of income and you want to get an upfront loss, you can actually invest in an oil and gas tax shelter. You want to call it a tax shelter, you can, and get the loss. And then as you get income from oil and gas income, 15% of it is tax free because you have what's called percentage depletion. So that's a tax shelter that's still around. Just to briefly go over some of the things that were limited by the new tax law. State and local income taxes and real estate taxes combined, only $10,000. That's all you can get. You can't get anything in excess of that. New York State, New Jersey, all these states try to do workarounds where you give money to a charity and offset it against your state tax. The IRS specifically is disallowing that, so don't even think of it. They're not allowing it. However, income tax. Business level taxes, for example, if you pay New York City General Corporation tax, that 8.85% tax I was telling you about before, that is deductible. Or similarly, for example, let's say you pay 4% New York City on a corporated business tax, that is still deductible because that's a business level tax. So it's not all taxes are still, you don't lose the state and local tax at all levels. Just to talk briefly about estate planning, the estate exclusion was raised from about 5.1 million to about almost 11.2 million, and that's per spouse. So it's almost 22.4 million. So if you're doing some estate planning, there's a much more wider amount of estate exemption. However, it does go theoretically snap back to the lower amount in 2026. Who knows if that's ever going to happen? You know, it's interesting. You want to hear about estate tax? The estate tax expired in 2010, and then the Congress reinstituted it in 2011. George Steinbrenner, owner of the New York Yankees, died in 2010. So George Steinbrenner's kids were very lucky; they didn't have to pay any estate tax. They reinstituted it in 2011, and it's been about a $5 million exclusion since then. It's been into inflation; it's up to like 5.2, and now with the new tax law, it's up to about 11.2 million. That's per spouse. So that's so combined, it's almost 22 million. That's It's very easy. If you have a business, it could very quickly be over that amount. So something you might want to do some estate tax planning for. But
Maybe people want to ask a question.
yeah, so let's switch it over to some questions. If any questions, any issues, any questions, any tax ideas that you want to bounce off?
Well, I was sort of telling you on Shabbos, and maybe we could have an idea of what to do. If I want to create in another country an insurance company that basically every time I fund a deal, it pays me just like a small mini fee, and basically buys all the profit on the deal that I do, but gives me a little fee, and that company is located in another state or in Israel. Or something like
okay.
that.
So the question is creating foreign entities. The new tax law created a morass of complexity relating foreign companies. It's like it's beyond there's beat, there's guilty, there's all these new acronyms they created, and basically it's an area that I don't think you want to get started in.
Well, I mean, if this company it's like I'm allowed to use an international insurance company to insure something.
Yeah, but if you want to shift income to an international company, a foreign controlled entity, there's all kinds of new stuff they passed in the new tax law to prevent you from getting the kind of tax savings you're hoping to get. This is the kind of stuff you really have to have a conversation with somebody who specializes in international tax.
I have a cousin who lives in Israel, and I trust him, and
I'm telling you, this is something you don't want to even get started with unless you speak to people who are specialists in international
Puerto
tax.
Rico.
Puerto Rico has its own thing, because if you want to shift income to Puerto Rico, I know companies have tried to do this, and they do. The IRS does with Section 482 adjustments, meaning that they know that really the income is really earned here, but you're trying to shift it to Puerto Rico. So the IRS sees through that, and they shift it back here. So it's called Section 482 adjustment. So
did that recently get enacted?
No, that's been in the law for a long time. where people try to shift income to lower tax jurisdictions, particularly Puerto Rico. So the IRS says, you know what, we see through your nonsense, and really all the income is really earned here. You're just saying it was in Puerto Rico, and we'll shift it back. So it's called Section 482, where they do that kind of. These kind of tax strategies are.
What if you truly live there, or like what if you actually move there?
Moving there doesn't help if it's really U.S. based income and you're just shifting income over there. It's not. It's very hard to get kosher food in Puerto Rico. You have to tell our friends over here about how difficult it was in Puerto Rico to get kosher food, and how if you want, the only mikveh in Puerto Rico was the ocean. And they built one recently, right? That's recently they built it. They just built one. Up until a few years ago, you had to go into the ocean if you wanted to use a mikveh in Puerto Rico. That's how. So that's. But luckily, the ocean's warm 12 months a year over there. So it's. Anyway, no, seriously.
Could a local pension insure my deals, or is that not an arm's length transaction?
You're talking about captive insurance companies. The IRS is out for blood on that. I wouldn't get started on that.
You said earlier, like a defined benefit plan. If a defined benefit plan invests in a business to buy,
you don't want to do that. You don't want to get started. These are tax strategies that you need to speak to a tax attorney who specializes in these matters, because shifting him to Puerto Rico is a whole 482 question. Shifting him to foreign entities. The whole new tax law was written specifically to avoid this type of income shifting, and it was specifically rewritten just to avoid these types of things. Not that it can't be done anymore, but these are areas which I don't know, and I would tell you I don't know, and I would tell you if you're really interested to speak to tax attorneys who do know, and they may or may not be able to if there's enough money at stake, it's worthwhile to do it. But I can tell you that they've passed stuff that's mind-boggling levels of complexity, specifically relating to foreign-controlled corporations, specifically to avoid this kind of situation. So, if you want, you can speak to. I can put you in touch with tax accountants and attorneys who specialize particularly with this kind of stuff. But if you want to, it's very expensive. This is not the kind of tax advice you get at prices that are. This is a whole nother level. This is like the major leagues of billable rate per hour you're talking about. So if you're really interested, I could advise you some people who do this kind of tax advice. But it's unless there are millions of dollars at stake, it's probably not worth the time and effort to do it. But because this is really beyond the scope of what we're talking about here tonight. But I can put you in touch with some people who do this type of work, who deal with control foreign entities, and they can give you some advice in this area. Mm-hmm. But they're not cheap. Call me. I'll put you in touch. I know a specific person who knows what to do, who knows a little bit about this, and they can advise you accordingly.
Was that Yale? Yale Fishman?
Not Yale Fishman. Yale is pretty much a domestic entity. He has some foreign entities too, I guess. Right? He's Yale is a real estate mogul. He probably has some people who you could probably put you in touch with. You might know as well. Mm-hmm. I think he's worth more than Donald Trump. Yale, is it?
Hope he's not your client, no.
No, he's not my client. No.
I'm saying like that. You're disclosing that, no.
I don't know how much he's worth, but I'm just guessing. He's
making $10 an hour.
Yeah. I don't know. Maybe he's worth less than Donald Trump, but I'm just guessing. The guy's very successful. That he's not my client, so I have no idea.
Mm-hmm. So what do you do besides for your regular day job? Could you describe what you do as a CPA, or like what you're?
I have some high net worth clients. Besides my day job, I have some high net worth clients. A lot of them in real estate, but in a lot of other businesses as well. And there's a lot of areas now that with the new tax law, the new tax law is a goldmine of opportunities. The 20% pass-through deduction, the opportunity zones. There's just so much opportunities here to take advantage of the new tax law. So some.
Do you have to declare gains from cryptocurrency?
Oh yeah. Oh yes. You must declare any
Even if
cryptocurrencies.
you don't sell, even if you haven't sold.
If you haven't sold it, there's nothing to declare. But if you spend cryptocurrencies, that's considered a taxable transaction. Every time you spend the cryptocurrency, that's considered that you sold the cryptocurrency. So if you let's say for 100 times you spent bitcoins for the last 100 times in 2018, you have 100 capital transactions you have to report. It could be gains, could be losses, but you have to report every single one of them.
And transferring it to a wallet that's in another country.
This I don't know. That I don't know.
It's
But if you have cryptocurrencies that went down in value, I'd recommend you sell and wait 31 days. There's something called the wash sale rules. That if you sell something at a loss, you have to wait 31 days in order to buy it back. Otherwise, the loss is considered a wash sale loss. Or you could sell bitcoins and then immediately buy back Ethereum or some other currency because it's not the same currency. So if you want to do it that way, but if you want to sell bitcoins and buy it back, and in order to get the loss, you can't. You have to wait 31 days. It's called the wash sales rule. But you could sell the bitcoin now and buy back Ethereum or some other cryptocurrency, and then you'll be able to get the loss. My recommendation is that you have substantial gains in Bitcoin or other cryptocurrencies and now you have paper losses because you haven't sold it yet, is sell enough to get enough losses to offset all your gains, wait the 31 days to buy it back, or buy Ethereum or some other cryptocurrency, which is as long as it's not the exact same cryptocurrency, you could buy it back immediately.
They have these remote little things called ledgers where you could like move your bitcoins from a wallet online and then transfer it to some physical thing where no one could ever take it or steal it from you.
Well, I don't. That doesn't sound like a taxable event because you haven't spent it yet.
No, so what I'm saying is, what if you quote unquote lose it? What if you lose your ledger? If you lose it, you're done. There's no way you could ever get it back. If you lose that,
So that's a business casualty loss. So you can deduct it as a casualty loss.
and there's no way they're gonna know like if you truly did actually.
Give it to me.
If you really didn't, then you did. If you really didn't lose it, but you're claiming you did, so that's fraud. So I don't recommend anybody get involved with that. So my old boss used to say that's fraud, man. So it's I don't recommend that. But I do recommend that if you do have Bitcoin that you could sell at a loss, and either wait 31 days to buy it back or buy back a different type of cryptocurrency immediately, so you can use those losses to offset your capital gains. That I do recommend.
You said something about the opportunity. You have to spend like 50% of the expenditure into improving the thing.
Yes. So
it's not simple. Like you can't just
just buy an existing building. No, it doesn't work.
You do like capital improvements, like you fix the hallways.
Okay, so here's what happens. If you want to take your money with the opportunity zone and buy and remember you have to be it has to be a qualified opportunity fund. It has to be it can't just.
How do you qualify? It's not as simple as just opening up an LLC. What's the qualification first of all with the IRS? Like what do you have to
Okay, it's complicated. And this handout that I gave you, if you read through it, it tells you exactly how to do it. You have to file a form. I'll tell you exactly.
An LLC already opened up.
It could be an existing LLC, but let me read you what it says here. It's not you can't just say I'm a qualified opportunity fund.
Of course not.
I can't just say wave a magic wand. There's a specific form you have to file. You don't have to create a new LLC. It could be an existing one, but I'll tell you which page it's on. It's a 29 page. I'll tell you exactly where it is.
Create an area as an opportunity area, or
No. It has to be. It has
already decided.
It has to be already pre-decided. No, you can't. It has to be.
Are there any Jewish neighborhoods that are in those areas?
I don't know. You could look it up, but I would assume maybe in Williamsburg there are a few.
Yeah, there are. In Williamsburg, there's a lot in the south side. I see them. There's a
Like
lot
specific buildings that
No, it's all over America.
It's block by block.
9,700 neighborhoods in America, and with those, there's a lot of blocks that are.
And it's
a
only
form
real
to be
estate
made.
there. It's all. What about business? Like
It could be businesses. You could do businesses too. Here's the thing: you have to spend. You can't just buy an existing business or an existing building. You have to. If you buy an existing building, you have to spend. You have to spend an amount equivalent to the value of the building. For example, let's say you buy $10 million in a qualified opportunity fund, an existing building, and let's say the land is worth $3 million. You get it appraised. The land for $3 million, the building is worth $7 million. So that means you got to spend $7 million and $1 to fix it up. And if you spend less than that, you don't qualify.
Okay, and how long do you have to do it?
You have 30 months. You have 180 days to take the money and put it in the qualified opportunity fund, and then 30 months once it's in the qualified opportunity fund to do
$1 million or $7 million in the property.
That's right. So they came up with a regulation which was very lenient that said this that you have to spend an amount equivalent to the property's value, $1 more than the property's value. It's only the building, not the land. The land. So if
But it was only 50%.
so that means, for example, let's say for $10 million you bought $3 million land, $7 million building, right? You appraised it. You split the appraisal between the. So you have to spend $7 million for the improvement. So now the improvements are more than 50% of the total value of the combined
So
value.
you bought the building for $7 million.
So if you spend $7 million, so now your improvements are more than 50%.
So you're just really putting $1
No, it's $7 million at $1.
plus the $7 million that
No.
you bought the building
It is $7 million of the price of the building. You have to spend on top of that another $7 million in one to improve the
So you
building.
have to spend $14 and $1. 14
Plus the $3 million of the land that you already spent
Yeah.
because
And
it's
how does
just
it work with a business? If you buy a business in one of these areas,
there's still regulations that are still pending. No one fully.
I'm sure I fund a few people in these areas. If I like set it up where like I'm quote unquote buying his business, and then part of my loan is like expenditures, so maybe
Can't be a loan. It has to be a specific capital
What
capital
about land?
expenditure.
So if you buy land and then you develop a building on it.
So that counts. So the whole
if
thing
you buy
counts.
a piece of land for $500,000. And
So then you're
costs
fine.
$1.5 million to build it. So all that $1.5 million is you can use.
So you're saying if it's land, you don't have to prove you don't do anything because land doesn't count. So that means that if it's land, then no matter what you spend, you qualify. If you're buying raw land and you improve raw land, you qualify for the qualified opportunity.
So then the money you used to improve the land is a deferral.
So the way it works is that if you, let's say you bought, for example, let's say you sold a piece of real estate, you bought it for $1 million, you sold it for $3 million. So you have $2 million to defer. So you take that $2 million, you can only use the gain portion. You can't take can't take the original basis. So the $2 million gain part, you take that and you buy, let's say, $1 million of land, and let's pay another $1 million to improve it.
Yeah.
So then you're fine. Then you're good. Then you've qualified, and then the $2 million you made on that building, it's deferred for 8 years. At the end of 8 years, you pay tax on only 85% of it.
If you sell it.
If you sell, after 8 years you have to pay the tax, even if you don't sell it. And the building you built in the opportunity zone, if you hold it for 10 years, it's completely tax free. If you sell it before, it's completely taxable.
So if you sell it, you got to pay the capital gains in 8 years. The gets deferred for 8 years.
85% of the capital gain, yeah,
And
approximately.
then in 10 years, if you sell it and you make $9 million, you don't have to pay tax.
If you sell the property, the new property.
Yeah.
So the old property, the one you sold,
You already
8 years from
deferred
now
it.
it'll be taxable.
Yeah.
The new property, whatever gain you make after 10 years, it will not be taxable.
Is the complete gain or only the appreciation? Because they say something about appreciation.
You're talking about the new property, or the old.
The new one, the brand new.
Well, the appreciation is the complete gain.
Oh, that's an extra.
Yeah, so the whole thing would be if you hold it for 10 years, it will be tax free. If you sell it before the 10 years, you'd have to pay the tax. The qualified opportunity fund, you can't just say you're a qualified opportunity fund. Let me tell you exactly what form you have to file. Let me find it here. It's 29 pages. You also have to meet certain criteria. They test it either semi-annually or quarterly. That you're actually spending the money on the.
What about the income from the new property?
I mean, like rental income.
Yeah.
Okay, that's fully taxable. However, the gain when you that will be fully taxable. Yes, that will be fully taxable. But the whole tax benefit of the new property that you build in the opportunity zone is that if you hold on for 10 years and you sell for a gain after the end of 10 years, that gain is tax free. But the profit you make from a typical rental income from the opportunity zone, that's taxable. That's not. There's no there's no way to avoid that. That's something that you can't. Let me read you what it says here. Okay, here it is. How do I know if a corporation or partnership, it has to be an LLC, is organized for the purposes of investing in a qualified opportunity zone property? What makes the determination? So the answer is the fund does. In other words, the C corporation or LLC is going to be able to self-certify that it is a qualified opportunity fund. There's even a new form. The new form is called Form 8996. It's a new form. And you have to file the form, and you have to, it's a self-certification process. The corporation or LLC will tell the IRS The first year it wants to be treated as a qualified opportunity fund, and even the first month. You have to tell it what month and what year you want to start. It is critical that because any investment made into this corporation or LLC before the first month that the qualified opportunity fund will be eligible doesn't qualify. So that means that if you like, for example, you sell a building from $3 million that you bought for $1 million, and it's long term, it's a long-term capital gain. So you take the $2 million gain and you put it into a qualified opportunity fund, which could be an LLC. But that LLC first to file Form 8996, say when I want to qualify, and only after you qualify can you actually put the money into that qualified opportunity fund. And then after you do qualify, then you have to certify that 90% of the assets are actually invested in the zone, which means that either 90% is actually invested in buying the land and building on the land, and of course, if you're first buying the land and you can use the remainder to build on the land, you haven't spent it yet. You have 30 months to spend it. So you have to show, they actually require you to show that the monies that are being held by the Qualified Opportunity Fund is actually being set aside to spend to improve the property. I recommend you read this whole article. It's really written very clearly, but you actually have to show, you don't actually have to spend immediately all the money to build in the fund. You have 30 months, but you have to show that the money is set aside for that purpose.
Can you take income and invest in the opportunity fund to improve the building?
You can only take the money from the gain on a sale of a capital gain on the sale of either a property or stock. What?
It's like a 1031.
It's similar but different, because a 1031 is different.
You have to sell something,
A 1031, you have to take the entire proceeds of the sale and invest that.
Come from a stock sale.
Right, but there's a very big difference. In a 1031 like-kind exchange, you have to take the entire proceeds and invest that. Here you have to take just the gain portion. If you take the entire proceeds, the portion that's not the gain, you don't get the benefit of the opportunity zone. You can invest it, but you don't get the benefits.
And once you put the money in the fund, you only have 180 days.
You have 180 days to put the money in the fund. Once it's in the fund, you have 30 months in which to actually spend all that money and actually improve the property.
Yeah. So once it's in the fund,
How long do you have to identify to purchase a property?
30 months.
Or until the money is...
You have 30 months.
So you don't have to pay
Purchase the
taxes
property,
on that
find
money
the
for
property.
30 months. And after the 30
You have
months,
to show that you have a property in mind and how you intend to spend the money. If you read through you really should read through this document carefully.
you can borrow it, loan it to yourself, and pay it back over the course
You-
of 30
you-
months,
you-
and then in 30 months you can buy the property.
You have to find the property.
Technically.
I don't know. I really recommend you read. I read through this whole thing several times already. This 29 page. The guy who wrote this, the tax geek Tony Nitti. He wrote a very good article. It's written for people who aren't CPAs. It's written for people for regular people, regular business people. I would read it carefully. Try to read it. Try to understand every line, because to understand these rules, you have to. If you want to self-certify by filing Form 8996, I would do it only with the guidance of a tax advisor to make sure you're doing it right. You need some extra cards, perhaps, to hand out to whoever you see me here.
Yeah, I'll take some cards.
Some of your friends and.
You have one. If you have like a fund, like a college fund, and you want to take it out, like it's invested in the market, and you want to sell it and put it in an opportunity fund.